Good evening, good evening. We're trading xauusd. We're trading audusd. I have a sell on gold, and we have a combination of hedging.
GJ is not doing much. No entries on GJ. Only thing that has a good shot of moving at this point is gold. Once it breaks those previous lows, oh man, that 50 SMA right there is gonna push this thing down. We got like the kiss of death there on the 50 SMA. What the stop on this look like? About 15.9 pips, 16 pips, quite decent. Decent stoppage. This is the move straight down to 23.59.22. These are the targets, you know, because there's not much standing in the way of price to continue moving down towards 23.58. But you're talking about, what are you talking about? 23.59. Oh yeah, that's the same mark. Just within this zone. Looks so good, man. But you know, just because it looks good as well doesn't mean that it's gonna play out. I do think there's a higher probability. Gold is golding. Also, you know, the thing is, there's a psychological number here, like, or rather a good psychological mark, the decimal, 2362. I really like the way
Every
that
single
lines
win
up with the
you've ever
SMAs
had,
and
whether
the
it was
closure
Forex,
and the clean
stocks,
range.
poker, the whole...
No one thought the price of XRP Ripple would drop so much. A lot of people got scared and sold
Yeah, the
their
price is
coins.
just moving
Don't
bearish
worry
overall.
though. According to experts, this is just a small setback that will lead to a huge win. XRP, the court case between Ripple and the SEC,
Oh
is
yeah,
doing
we got
well.
like accumulation here as well.
That's pretty cool, right?
So
Also, they
it's
think
kind of
XRP
break
could go
out
up
of
to
this
$200 or
accumulation
even
zone.
more. You really can't miss that movie. Hold on, because that
Where
is
all
one
these
of
orders were.
Nota bene.
So
Recently,
anything,
there has been
this
a
would be
big
the
drop
point
in
A,
the value of
and
cryptocurrencies,
this would be the
and major
distribution
digital
over
assets
here.
have lost a lot of value. XRP
So
Ripple
it's
has
not
dropped
just about
sharply.
probability.
For the first time
What's the
since March
probability
2023,
of
it
this
is now
setup
worth
here
less than
working?
40
You can't base
cents.
a
Even
strategy
though
off
prices
one
are going
trade
down,
or one move
some
or two
experts
or
think that
three or
XRP
four.
could go up again.
Right? It's just about like how many of
CryptoRiver,
these
a
setups
prominent
actually end up
X-user,
playing out in the
suggested
long
that
run.
XRP was in a consolidation phase
But
as
this is it.
trading
This
with
is
the
where
13
most
cents
people would be
and
getting stuck in for
$1.50
sells.
range.
And
Another
it's either
expert
going to
on
be like
crypto,
a winning
said
day
that XRP
or
was getting
like
close to an
maybe
important
market gives
resistance
an
level called
opportunity to have
40
their
Achi, which
losses
is worth
even
about 46 cents.
more, to have
People
to
thought that
lose
XRP
even
could
less.
go as high as $27 if past trends happened
Or it's just
half
a
as
flat out
often as they
winning day,
did.
but there's about
This
2
shows that
minutes
even
here
though
on
the market has been
these
going down lately, there is still hope for XRP's possible comeback. The
But this is
ongoing
it, like,
legal
if
fight
price
between
starts to
Ripple
move
and the
from this
Securities and
point,
Exchange Commission
there's
is
no
another important factor
entries,
that
like
will
that's going
affect
to
the
be
future of XRP.
distribution.
The case, which started in
So
December 2020,
you're going to be
says that
standing
by
in the
selling
way of a
XRP
falling knife.
tokens, Ripple and its
If
executives
you
did a
start buying
securities
for
offering
whatever
that
reason
wasn't
over
registered.
here.
At
It's
one
like,
point,
you know,
our
the
team
train
was
has
earning
left the train station
300,000
and
XRP daily. Now, we're excited to share this opportunity with our subscribers.
you missed the
So
train.
benefit too. Hello everyone, Mike here. I'm thrilled to be with you all today in this video.
You missed the train.
We're going to explore the increasingly popular strategy of arbitrage. Specifically,
Well, I
we'll
was
discuss
flip-
the method of arbitraging
And this is what I mean,
XRP
Chad. Like,
between
I haven't
highly
been
liquid
seeing any
exchanges
sharks in the water.
and the Canadian
Like, these
exchange
moves have all
index,
been
which is
playing out.
available worldwide.
I think I
Enjoy
got
watching.
like,
After Ripple's victory in court
maybe I
against
got a bit
the
of
SEC
luck.
at the end of
Maybe
2023,
that-
which confirmed that XRP is not a security token, Ripple's
You know, it's important to trust the process. It's important to learn from your positions. I definitely did. I definitely took something away from today. So maybe it's all in God's plan. Yeah. So this is nice. This is nice to see. The train has left the station, and we should be heading down towards 2258. Gold kind of knows how to play with people's psychology. better avoid that same thing it does, because it kind of uses the same tricks over and over again. So yeah, congratulations, man, if anybody executed on this move. I think that's really nice. Now this is the next point A we're talking about, and we're getting that follow through. I was capped, I couldn't do anything. You know, like, one of the cool feature of 55 is if you lose like 1%, man, MT5 should just lock itself and stop anybody from taking any sort of positions. That would be a cool feature. So when you try and hit the buy or sell button, it just gives you that sound like Fabio, you're at your daily risk for today. No more trades. Your broker should give loss refunds. That would be nice. Both kind of knows how to play. Oh yes. Hit a milestone today. Doubled my scalping account. Thank you for all the value in your streams. Really has taken my trade to the next level. Wow, amazing. I'm really glad to hear that, Doc. Sorry, micromanaging my trade. I'll send a photo in a bit. What did you get from this push? About like 14 pips. This is a move straight down. Silver, please. But we don't really look at silver. We don't do that here. But you can send in a chart. If you look at your chart, you can have a good idea as well. Gold. You have a green journal ID. Yeah, we'll try and maintain. We try to keep it as green as possible. Yeah, we try to keep it as green as possible. But, yeah. Yeah, I'm literally at entry now. Oh, nice. I just go take a... Oh, you missed the trade. Yeah, that's why you don't go take a shit when you're trading. Because, you know, when you come into the charts, you're on the charts to work. From like, let's say whatever time it is that you come, like from 5 to 6, that's when you gotta be in. Man, if I was running a hedge fund and you said you missed a move because of that, you'd be fired, sir. You're fired. Because those are money-making hours. You know, do all that you need to do before the time that you get onto the chart from 5. Let's say it's even like just 2 hours. Surely 2 hours. You can spare 1 to 2 hours in a day without any sort of distractions. If you have like kids, maybe you could tell your wife in advance or who you need to tell to manage the kids. But it should be from here to here, or from whatever time you trade. Take your laptop with your problem solved. Have you guys seen those refrigerators with the screens and you can put your trading view charts on them? That's also quite neat. But you can have like a screen installed up to the floor of yeah, when you take a crap. You can always look at the charts. Go and play with my emotions. Why, sir? It's doing exactly what it needs to do. problem is, maybe if you're in buys, you're afraid that price is coming down. This is really good. Because it's still got some range on here. It hasn't hit the TP, so in a situation like this, I would accept more drawdown. If I wanted to hold longer, it would make more sense than it did up here, because up here it already hit TP. Correct? It already hit TP and then it came up. But here, there's still room to come down. The only other way you could manage your risk is if price comes into entries, then you could close half of your position. If that was to happen. So there's quite a few ways you can manage your risk here. Because as I said, like the really good setups, they shouldn't be coming all the way back into entries. They should just keep flowing from this point. Like at the entries, it might have some retracements, but ideally you just want to see it keep flowing down. Down towards 23, 23.58, 23.58. Where you can wear hoodies. Exactly, just take your laptop for photos.
USD is going up.
Oh, no, it has no bottom wick?
USDX is
This is not really an entry confirmation. It's like
getting some buy volume.
okay, like no bottom wick. I feel
Starting
no
to
worries,
go
no
above the
bottom wick.
50.
Oh, actually, I do have a bottom wick here. It's a really small one. Also,
Oh,
my
yeah.
profit is a bottom wick.
Gold down. Aussie heading down.
GG has been very nice today, unlike last week. By the way, why don't you use trend lines? Trend lines, like as we mentioned, like they're a bit subjective. It all depends on how you look at the market. Some people can draw them on the candlestick bodies. Some people could use the wicks. Some people could use the bodies and the wicks. But if you look at a horizontal line like this, come on, chat, like we can all agree on what's going on here. Right? I think this looks so simple, and that's why we trade TFX concepts. I'm not sure how of course, like someone in their first year of trading, or their first few months of trading, maybe they see it a bit differently, of course, but I still think it's the most simplest way to do it. Like it does not get any simpler than this. It does not get any simpler than TFX concepts. But this is just one model, right? This is one model. We have the break and retest play, we got the market fade play, we got the consolidation play. But this is one model, and each model is simplified as much as possible, but this is definitely one of my favorite models. This and the consolidation play. But if anybody looks at this chart, there's nothing much you can say. You can only say that price consolidated here, correct? We can all see that. Price moves sideways here. Market only moves bullish, sideways, or bearish. Clearly see this, right? Now we can clearly see a candlestick broke out of the consolidation. So what are the probabilities that the next candlestick continues to go bearish? So you got like a high probability, and we also got some pretty good range here, and you know, the rest is history. But that's why I think like analysis should be the easiest part. Usually I come onto the charts, I don't even have to do 5 minutes of analysis. And that's like stress-free trading. Sometimes you can come into the charts and everything is just clearly laid out for you. Just like when we got onto Zoom That's the first thing that I saw. We didn't do much analysis, just like a quick breakdown of these potential buys over here. Those played out beautifully. But what you don't necessarily want to do is every single day coming on, doing like daily time frame, 4-hour time frame, weekly time frame, 1-hour time frame, 30-minute time frame. By the time you're ready and you're ready to execute, man, it's been like 20 minutes or like 15 minutes. Yeah, I'm just saying this because it happened to me. You know, that's how I learned, was marking out the charts, reading them every single day, and starting from the higher time frame. So it's like a lot of work. I'm not very smart, so if I make it more complicated, man, I'm gonna lose more money. I use bodies. Wicks are just a distraction. Yeah, the wicks sometimes leave like blueprints of where it wants to go. You know, that's why we're looking at the wicks up here, and we're seeing this was a key rejection point. And you look left, we got like a supply zone over there, and we got some speed bumps. We'll price move bullish, so that was like additional confluence for these cells, or rather this cell. Are you in a trade? No. I sold 2 times, made back in profit in my small account. Oh, nice. I mean, it still has room here, you know. It has about 16 pips. So we just created a support. That's the only thing. Also got room to move up. Go on like 30 pips. Allow how patient you are. You can trading and over risking. It's just art. Yes, man. Like you can see these trades. You could have easily caught this one. It could have easily caught this one. It could have ended the day in profit, but that's not trading. That's gambling almost. Because that would be 4 trades. But that's why I always say the skill is important, because see, when you don't have the skill, man, it feels like an eternity now because you've taken a loss. But when you have the skill and you see your things playing out, man, you can be more patient because you know you just gotta come back the next day and easily make it back. But what I'm protecting here is not my account. What I'm actually protecting here is my psychology. Because God forbid I took another trade and I lost that trade. You know, that's not gonna be good. My psychology. Rwanda doesn't have the tiniest wick. Let's see. It's in distribution though. Right now, it's just having some sort of retracements. It's still playing out. These sellers are still in their trades. There has not yet been any structure that's been formed here to say that this is now going to become a point A. These are just common retracements that we typically get in the market when we're heading into directions. That's why I love trading, man. That's why I love TFX concept so much, because we just break it down so simply. Point A, point B. What phase in the market are you in? Are you still in point B or are you in point A? What do you need to do? Right now it's more of like managing risk. It's not time for setup. It's distribution. Maybe you get people getting re-entries. That could be an interesting risk management technique too. You get to sell a series secure profits, get into your re-entries. If it's a loss, you still manage your risk. But the tricky thing about doing that is sometimes price doesn't give you the re-entries, and it just keeps going. seconds there, holding this 5-minute candlestick nicely bearish. It's looking really good. No sharks, like literally no sharks today, guys. No sharks. Just got a bit unlucky. Well, maybe a bit of sharks. Maybe a bit. Maybe a bit. But not too many. And not too aggressive. Ooh, we rejected the support. We rejected support. Created resistance as well. It could start creating a point A here at any moment. I think if we start to break above here, the structure is going to be changing. We're going to create a double bottom. The daily close wants to flip, maybe more sells on the flip of the daily candle. Oh yeah, we're down 0.06%. We're about to flip. We just need to push like 15 more pips to flip bearish. Do you have FOMO? No. The daily, I don't understand, sounds like voodoo magic. How many hours would you work as an employee? I now worked 12 to 18-hour days as a business owner. Yeah, I don't know if that question was directed to me, sir. But as a business owner, of course, you're going to work more than if you're an employee. But you know, you put in more work, and in the end, you get paid more, and you work less in the end. So it's just all about like setting things up. That's why I said like becoming successful is really not that difficult. All you have to be is like very organized, seek out the right mentality, the right direction. And the important thing is the direction. You know, like if you have someone who's done it before, man, it could cut your learning in half or even more than half. But if you're doing it yourself, you really gotta put in the work, and you have to have that grit to not be afraid of losing and failing, because you have to understand you're at a point A right now. You're not at a point B. A lot of people come to trading, they already want to be at the point B. But yeah, man, you're gonna be in point A for quite a while as you're figuring stuff out, and it's a process, you know. But once you break out, man, that's when things now start to sort of like everything makes sense in the end, I would say. And that's something like a lot of traders get stuck here in this break-even phase. And it's usually because they just need to change something. It's maybe something in their psychology, maybe they just need a bit of direction. And it's the same thing as professional athletes, you know. A professional athlete needs to get better. If Conor McGregor needs to become a better boxer, if Mayweather wants to become a better boxer, and they're not finding the results they want to find with their coach, maybe they might need to seek a different coach and take what they've learned from that coach and keep moving on their journey, because in life is a journey. You're always going to keep learning from every single person. Like I've had several mentors in trading. I've never just had one mentor, but I've taken all that I could from each one of them to better understand the markets. It's trying to go up, but those wicks are indicating a failure. The thing about the candlestick, it can do anything. Until the candlestick closes, we don't know what the true intention is. Because yeah, you're right. I mean, it was bullish, but now we have 30 seconds on the clock, and it's just flipping between bearish and bullish. So it could close either one here in the next 26 seconds. So that's where it's really important to wait for candlesticks to close. XRP zone. Alright, that also makes a bit of sense. While we're seeing some sort of reaction over here. So green range on the 15, but the 30 minutes still looks good. We just got the 30-minute candlestick close. 1 hour still looks good. There's still a bit of room for it to move down. But we have rejected 2360. We haven't gotten a candlestick close below 2360. Yeah, that right there, man, that right there I don't like to see. If I was in this sells, I would really look at that as a potential reversal. Because that's not a stress-free position now. It's created a double bottom. Man, if it breaks above and closes those highs, I would be scared about this position coming all the way back up there. Because, you know, you have about like a 26 pip range to continue moving bullish. It's created like some form of support. And it's already pushed quite good. I mean, just about 19, 20 pips. Yeah, DJ is garbage. You give DJ some whips. It's not a reversal, it's just range action. Push up again, then crashes the last bottom. Yeah, it is, but this is where psychology comes in. Because would you want to take that drawdown, seeing that there's a double bottom being formed and it's coming back up? This is where psychology really comes in. But I really prefer the stress-free trades. Like this thing has already pushed like 20 pips. I wouldn't let this position become a losing position after a push like this. Even if I was chasing like RR, in this specific scenario, I would rather get out of DE because this is too much work that the market is putting on my psychology. I'll just put this. Let's do this. It shouldn't be coming up there. And you'll see in the long run, the ones which do this, man, those are the ones which really go against you. It happens all the time. Watch out for it, chat. When you see price consolidating or struggling, just this little market's giving you like some kind of hints. It's the same thing that happened. Maybe we could use this example. You know, price consolidated after bringing a key high. Buyers here, these were buy entries for earlier on. So let's say if someone was holding these long positions, correct? Like you see price consolidate like this, man, that is a reversal signal right there. So markets are kind of like yin and yang, correct? So you see this happen here, break above, green range here, and now price is consolidating, that's a reversal signal. It's the same thing that's happening right now with these sellers over here. Price broke above, this consolidation on the 1 minute time frame. So it's this, but you see it there on the 1 minute time frame. This, you see it right here. And most of the time when it happens, then your stops, for the most part, tend to get hit. So I would be like, I would put my stops to break even. So like right here, you wouldn't have noticed it. In hindsight, you could see it, but here after the retest, it still looks good after the retest, correct? But now you see like price is struggling again, creating rejection over here, starting to move sideways. Now you consider put your stops to break even because we shouldn't be coming back down. The best setups usually don't come back down. So you just want to manage your risk already and just call it break even. Especially if you push up so much and retest your entries already. Safest way to play it. Let's see the 1 minute. Yeah, as we're coming up, it's gonna look more like consolidation. But you see, it's still good. You're still good. Protecting your psychology, stops to break even. You haven't yet been tapped. I closed so we can just trade again off that. Yeah, you gotta get worse entries, or rather, it's much safer to, if you wanted to do it, it's much safer to have just done this. Because the scale-ins are obviously you're putting on more risk again on the scale-ins, but we just close support, then you come to down. But you know, to each his own, that's also a respectable way of managing risk. Because in any case, if you lose the second position, maybe you go into it like half risk. Yeah, you can still end it. You can still end it profitable. No, I trailed my stop to profit and was stopped out with some of it. Oh, nice. You can use that TFX SMAs if you want to trail. Just wait for candlestick to close the SMA, then you can trail with it. Still no sharks, man. If we break those lows, we should continue coming down. Yeah, it should continue coming down. There's no bicycles currently, unless you're a fake out trader, which I think fake out traders are just a scum of the forex and trading world in general, because they tend to like to really go against the grain, which is quite annoying because yeah, man, I guess it is what it is, but it's quite annoying. It should be coming down. There's no other entry for buys unless you're a fake out trader. Give all the fake out traders in the chat whips. You know yourselves. I guess it will come down to 23.55 and then we will see bull. Yeah, these are the two targets we've been talking about here the whole time. So this was target 1, this is target 2. That price needed to tap these levels. Ran out of ammo today, so I couldn't do nothing. But that's why we stream, that's why we provide value here. Because it's not just about taking positions, but also just seeing how to take the positions. Yeah, man, I ran out of ammo. Oh, we just got 23.58 here. Nice. 23.58 here's the tap. Beautiful. Oh, should be seeing some profit taking. We're inside the general zone of 23.58. That's a 30-minute support, 15-minute support. Profit take it, profit take it. Let's go, let's go, let's go, let's go. 10 pip banger right there on that second move. What do you think about Fed Powell's testimony? Let's see. He's gonna be defending interest rate hikes. That's what his office has been doing since like 2 years ago. They've just been hiking rates. So he wants to support that, and that's the stance that I'm imagining he's going to be taking. So he's going to be hawkish on the US dollar, and that's why maybe we're anticipating some bearish moves here already. Rather, he would like to be hawkish. Let's see what he says. What do you think? Touch TP, yes. This seems like a DXY rally to the upside effect. Yeah, it's coming in. Really nice, man. Really nice price action today, I have to say. Really nice structure, really nice volume. Looks very good. Break-even stop. Would you make break-even stop would have made more sense? Good tip. I remember that. Yeah, it's usually. But you said you wanted to scale in. I mean, you could have. Your scaling would have still worked out in your favor. I thought this is what you meant to scale into this. That's why you wanted to secure some profit size risk management. Up 4% of my portfolio with this trade already. Oh, nice. Yeah, I'm down today, man. I'm down 0.70%. But that's it. That's the analysis right there, man. Like, there's nothing more here. Everything here doesn't look very appetizing. Like looking at all this price action at the back, this is it. Right here. Now I think we're just waiting for the New York session. Maybe for New York session we can see some longs. Because we've created like somewhat structure. It would be nice to see it continue ripping down. But we do have some kind of range over here that's been formed even from here to here. Oh. One minute slipped on a banana here. Push down about 10 pips. It's happened to me a lot where my bias is correct, but I enter against not how many times just for the market to reach my target when I'm exhausted and out. Just pay attention then to like, I mean, it can happen. It depends on your strategy, how your strategy operates. I think, you know, no one is going to have better insights into that than you. If you're building your own strategy, you have to find a way to refine that. How many times order block fails? Man, so many times. If there's been bullish order blocks here, then yeah, TFX for the win. Concepts. TFX concepts for the win. Entering too early was my problem. So you gotta wait, sir. You gotta wait longer. I think for me, Um, oh, yeah, for me, one of the main things was not waiting for candlesticks to close. I couldn't do that. Even if it was 10 seconds, I couldn't wait. And it would always reject the level I was meant to wait for the close. So if you're missing because it's too early, maybe like if it's a candlestick close, you gotta like nail it to the actual problem. You know, don't say that it's too early and like put yourself as a victim. Just look to see why it's too early. Is it because of a candlestick closure or what is it? Golly. Miss a sell limit by 2362 by the slightest. Remember, why do you choose gold and GJ only? What's the things you like? These are just the two pairs I've been trading since the beginning. The beginning of time. I've just been trading these two pairs. I used to trade USD CAD, but GJ was the main pair I used to trade before I traded gold. So I started realizing like some days like GJ just was not moving at all, and I needed something with a bit more volatility. So the obvious choice, of course, is gold.
Be ready with Allianz. Allianz.
Hey, you lovely people, Jamie Oliver here. I'm going to rustle up a stunning prosciutto raccord with garlicky beans in T-Bow's dual draw air fryer. T-Bow's dual draw enables you to create a complete meal in no time, with no need to preheat, saving time and energy. The sync setting also means that both draws finish at the same time. This looks amazing. It really is that simple to make something super tasty. So there you go. T-Bow's dual air fryer on ease and time and help deliver big on flavour. I reckon it will soon be your favourite bit of kitchen kit. What are you waiting for?
Yeah, there's some in there.
Oh.
You can put some in more. Crunch those ones as well. I used your paper. Yeah.
No, yeah.
Not much happening today.
What the market?
No, I haven't caught much today. I've caught one. I'm in profit and I just get the stop loss there, but nothing big yet. Waiting for the news. But every day you can catch something, you know, a couple of $100.
Yeah.
Where you going? Come have yours.
No, I left my CDs downstairs. Papers?
Sorry?
Your papers?
I got these, that's it. I ripped one in half to make a joint. I can't make them that long.
Yeah.
What trumpets. Oh, it's come down. 352, 350. There's that.
What, have you made a couple hundred today?
Nah, today I haven't. Yesterday I probably did. Yeah, yesterday I did. Day before probably done 100 or something.
I like closing trades more often than we used to.
Oh, a lot more, yeah. Like now, look, this is all I've got. Just a couple of small buys on AUS and a very small sell on gold. But, you know, I'm like in profit. Those ones I can hold, like I should have taken it there. It is on the daily chart. So I've figured it out. I can hold it, so I get back in. So that one is worst case scenario here. It takes up $10. There's 4 of them, $40. Yeah, I can hold $40 to here. And then I go in again with more buys here. This is on a daily chart. You know what I mean?
Yeah.
They're working with daily charts and that. It's the higher the time frame, like the easier it is on you. But gold's a bitch. It's just in a range on the daily chart. It's in a range.
What do you mean in a range?
Look, show you. Yeah, yeah. Between that green line and this red line here, it's just playing here. You know what I mean? Between this and this. That's on the daily chart.
Oh, okay.
Yeah. So the last resistance is here on the daily chart, here. Right there. Alright, so Anything's possible. Yeah, but it looks like it's more of a down than an up. Because today it tried to make headway during the day in the morning, and then by the time the British Open started, the London Open, it just pushed down. That's today so far. And now you've got the US market's going to open, so it's got to at least go to this green line here, and it could push down to this blue line and then keep going. Yeah, that's on a day chart, so you're not, what do I do? Nah. Like I said to you yesterday, I'll let them come to me now. It's like, fuck chasing it. Don't try to make it, you wait for it. Let it. And that's the hardest part, to wait. But if you do wait and you get a clean 100% A set up, then you can go with a big lot. Not too big, but you know, big with a small cells stop loss. So now on the 5 minute, if you're looking, it's travelling down, see? See? Down, down, down. So it'll just come up to these lines. So we'll try to go down with it today. Huh? Yeah, but they get messy. They get like, after trading for a while, you realise the less mishmash there is, the better. You know what I mean? Like these EMAs, exponential moving averages, they work good. You use a 21 and use a 200, and that gives you a clear picture.
What is that Asian guy?
The Asian guy, I think he's back on, I don't know. 'Cause after the, huh?
Aren't you watching him?
No, but after the Asian session, or the London session, he went off, and then he comes back when the US session opens, which is another hour and a half, then he'll come back on again. So he doesn't sit one full stretch. He comes in at the start of the session, tries to catch a nice one, and then stops, waits for the US session, tries to catch a nice one, and that's it for the day. No, I trade a little bit different than him, but yeah, whatever works. Where is he? He's not on now. Tonight you've got the Fed speaking, so whenever the Fed speaks, the market just does this. Yes. Because depends on what they say, that's how they make decisions on interest rates and shit like that, and that all affects the market apparently.
Even crypto.
Everything. Like the dollar gets affected. When the dollar gets affected, XRP USD gets affected, BTC USD gets affected. All the US currencies. Yeah, but XRP's found its bottom, so you won't have any nightmares than what you're having right now with it. It's here. So it's a good time to start loading up. I even put buys on this with XRP. Yeah. Yeah, like I think some of them are in profit. Yeah. 3 of them are in profit. Yeah. Hey, have you got anything saved up for your computer?
No, it's all in crypto.
Huh?
It's all in crypto.
Okay. Even if you start just 200 from every paycheck,
Yeah, I can get it probably.
yeah, just do that 200 from every paycheck. As soon as crypto goes up, I'll let you know. If you want to withdraw to buy a computer, then do that.
Did you end up getting yours done?
What?
The computer.
Yeah, it's supposed to come. What's today? Wednesday or Thursday?
Tuesday.
Tuesday. Yeah, he said Wednesday. So Wednesday he's gonna bring it.
Mm.
Yeah. All right. Yo.
So cold here. Do you need this tobacco?
No. I think that was okay. I left it there.
Put in this bag.
Yeah.
Oh, no, no, no.
Huh?
It's humongous now.
No, we don't make it that big. We cut the paper.
Yeah, so it's like a whole tree has been grinded up in there. Backyard mulch now.
Put tobacco on it.
I want you put it. I don't want to let you.
Put.
You know, I just,
What's wrong with you? You got a piss or something?
no, it puts you on edge.
Ooh.
Really. No, I don't need a piss. I'm really.
Perhaps this is what the invasion of frogs described in the Old Testament looked like when 10 disasters struck Egypt. This is not some strange trick, but the refraction of light at the interface between the two different substances.
You bring any filters up?
No.
Oh.
I don't usually bring filters.
You don't smoke cigarettes anymore.
I
This is
never
not-
do, I swear.
Yes.
I hate them.
Now you hate cigarettes.
I do. I never enjoy it.
Then quit.
Do not prevent it from moving around and living a full life. That's not what she imagined when he said he would be waiting in the Mercedes. You need to face the truth. It's immediately clear who the real star of the show is. If you don't want to find a new Slowly and surely, this snake disappeared in the sand. This can help it hide from predators or protect itself from extreme temperatures. This is a truly magical place that evokes a sense of calm and tranquility. It's not always easy to find a place to relax in the city, but this fountain certainly creates an atmosphere of calm and relaxation. So right now we have a clearer picture of what price wants to do. So what I'm going to do here is send you guys exact analysis as to what I'm looking for on gold. Right, so I want to see at least, how many guys are we at now? I want to see at least 370 likes, ladies and gentlemen. Let's go ahead and I'll prompt out the analysis for gold for you guys. Okay, so go ahead and smash it up right now and type go in the chat if you want me to send it inside the Telegram channel. Okay, we're looking for potential entries of gold right now. So let's go ahead and make this full screen first and do the analysis here for you guys. Oh, look at that. That's a mad volume here. Okay, so this is definitely a changing character, no doubt. Definitely a changing character. But let's see. Okay, price is currently rejecting off a 50-minute bearish move. This side again has been completely obliterated, but we do not have a body candle close just yet on the 30-minute time frame. Okay, so let's see what price actually is going to do here. Let's go ahead and craft it right now. Give me a few minutes. Okay. What is the 1 hour doing here? Okay. So this is a 1 hour POS, yeah? And price is also testing a 1 hour OB. Something to take note of. Okay. So let's see. This is a 1 hour OB itself. Look at that. Volume rejecting of this OB. Okay. Remember, I didn't see a body candle close. Okay. But currently, the bear sentiment on gold is looking quite strong, especially since we have a 4 hour momentum. So let me go ahead and grab that for you guys here right now. Trump's EP out, is that? But the market at the moment is predicting a September rate cut with a probability of 75%, which is pretty high. So Jerome Powell, I think today will do this last rudder act to try and convince the market that he will stay there. Of course, I mean, he'll be strong.
The closure itself is still above our key zones, our key levels, and we started to go. We started to go. would you be comfortable with? I would still be comfortable with shorts until we start breaking out and we start pulling back and something that then we start breaking strikes to the upside, we start holding up. But this is for me like an entry model 4, in case you guys know what it is. If you don't know what it is, then, oh wait, it's not updated in the ebook yet. It will come though, it will come. But this is an entry model 4 play, where we perceive you start re-breaking the lows, and that's kind of the setup I'm looking into. Why? Because you have these 2 wicks. You have these 2 trade setups right here. So these 2 wicks, the candles ripped on the 1 hour. This on the 1 hour time frame, so it's a serious break. You come down, you start breaking up first, and then you break down. Liverpool's market sentiment is 58% short. Does the market give retail win? Hey, this is your only confidence right here for fundamentals, then good luck, my friend. I'll give you our full report later on. And we can talk about the fundamentals if you want. If you think also that matters on the lower time frames, then good luck as well. Because, we've seen this before. Joe says I'm the only one bullish on gold. I don't think so. But the question is, yes, maybe we're going to be bullish, right? Long term, I'm super bullish. The question is just about today, about this session in particular. If you would be bullish here, then where would you pay your stop losses right now? Would you place it right below? That could be. What would be your confirmation for your entry? That's what I would be curious about. What would be your entry confirmation if you would be bullish here? Where can I do bullish? I mean, break above the highs here would be fantastic. Break above the 65 would be amazing. Like there are a lot of good solutions for longs as well if you start breaking above. Said no sir, already rebound will never drop to 20 to 52 anymore. Okay, if you say so, then great. Then you should go going? Good man. Yes, overall very good. Ups and downs though. You know, this is what tends to happen in boxing. It's like you have your ups, you have your
Yeah.
downs.
Oh.
Sometimes you feel
What
like
an asshole.
Oh,
you
it's
know,
just there.
If you were
other times
downstairs,
you get your,
Oh,
you
it's
get your
there.
ass kicked. See what it's ready.
You want food?
no, just something to drink or something. No, it's just.
No water, nothing. Nothing.
I've got some water.
Oh, some water.
No, I've got some water.
What would you want?
I don't know, drink.
With Pepsi?
Yeah. Can I have a Pepsi, please?
Oh, there's water there too. It's not that bad.
It's not that much.
That's a good idea, a blanket there.
Yes, I feel like an old man now. No, you know that.
Yeah,
Always.
you old fella.
Old men always have the blanket.
Yeah.
Yes, now I understand
What would you look for lunch?
why they do
Maybe
that.
something like this.
Because they live in Melbourne.
Yeah.
Because
Because they live with the doors open at night.
Yes.
There are two scenarios. If we start breaking this previous 4-hour wick, I can see kind of like a safer sell.
Yeah, please.
This high, or the previous high is, you know, as our stop loss. Targeted at 2047, coming down here. That might give us the impulse, especially around the New York session. Right, the New York Stock Exchange open. But if you do, let's say create a breakout here. So let's say you break out of this level, the 2364. You now have like a W formation with like a higher breakout, still holding above the piece of very high. We're still holding above this initial zone. Which is kind of this consolidation and then breakdown and then a breakout. So if you start breaking above that level, you start closing above that, I mean, yeah, that we might be flipping the script here. But I want to see this happening first, and if it happens, fantastic. And if you roll over, fantastic. What would you prefer? I mean, I would prefer to roll over. I'll prefer to roll over, but we'll see. Where do you need to close above? 2364.4. Yeah, just above these bodies here, depending on what bow you use. Yeah, but for now, definitely, if you want to see that, you really want to see somewhat of a closure above, that would be ideal. And if you roll over and we start breaking lows,
There you go.
it's going to be more aggressive.
Thank you. How are you doing? Studying?
Hi, Lorenzo, player from the Philippines. Where is the current supporter that we have for 1 hour? The freeze week very high, 2360, my friend. Has been respected very well. Wally says, I know you're like 6'3". Who are you fighting? Because Balinese guys are average height is around 5'8", and you smash guys of that height. Well, I fought some killers that are like 5'9", and they're absolute destroyers. But anyways, yeah, I agree. That's the main reason why we have a very hard time in finding good opponents here in Bali, because most of the locals are smaller. So yeah, that's definitely a problem. And that's why my first fight, my sort of previous potential fight got cancelled, unfortunately. So yeah. Entry model 4 is really amazing if you are kind of looking into the counter trend trading. So number one, the entry model ones are usually for these type of counter trend trades. You can take them also when price continuously drive, pulls back and pushes up with the trend. That will be the ideal case scenario, but you can also take them when price comes down and it stabilizes at a critical key level and it still holds up. If it fails, there are two ways you can utilize it. If the momentum is strong, then you can also place a new entry below the lowest instead of your initial entry model 1 trade setup right there. Okay? So instead of taking longs right initially, or maybe you took long, but maybe it failed, and you start breaking the lows, and there's momentum, there's buoyant, there's session buoyant, then an entry model 4 comes into play, and you place your wick, your stop loss above the previous wick of the third candle, and you look for that rollover, right? That rollover play. It kind of looks like this. That's your alternative setup, so you can hedge yourself also. If you're familiar with that, I think it's something to think about. Okay? So especially like strong momentum, that's usually what you want to see. So it comes down to a filled break. You have EM4A, you have EM4B. EM4A comes down towards the manipulation of the previous candle high, and EM4B comes down to the non-manipulation of the previous candle. But because you haven't manipulated the previous candle high, you want to then take the first.
Susan spent so long comparing energy providers. By the time she'd finished, she'd become a myth.
Alright, so market opens up in 7 minutes, Chad, 7 minutes. Powell, again, does their speech very soon. Do you think real estate will come down or just stay flat for a while? I'm not sure. That's a question I'm not sure. Bitcoin long-term auto hedge against inflation. Yeah, no, I agree. I think holding something long-term needs to happen. Again, if you're not hedging against inflation long-term, you're losing money, and that's just the truth, right? And so you got to hedge against inflation with something. I would go personally with real estate. I like real estate. You can do it with real estate investment trusts, or just buy a rental property long-term. If you buy a rental property, you're going to earn about 5% appreciation over time. So just the value of your home should, in theory, keep up with inflation, but you're also going to earn cash flow through rent payments if it's a rental property itself, right? So, that gives you the best chance of like good appreciation long term, and you're actually going to own something. You're going to own an asset. If you need money, you can take out loans against it or do whatever you need to do. And I think it's just a good asset to have. But everybody's different. We'll see. Some people would prefer to just stick it to the S&P, and there's pros and cons to it. Is it actually really possible to get started in real estate without any money? You got really good credit, maybe. But this is investing. Money's the name of the game. If you don't have money, you're not going to be able to invest in anything. If you don't have money, it doesn't matter to begin with. Looking at our poll numbers here, we asked people, does monetary policy reform Trump help or hurt the financial markets? 51% think it helps, 33% think it hurts, and 60% think it want to see the results. Alright guys, the opening bell's about to happen. We're going to get ready to day trade here. I think we're just going to day trade our regular toss account though. you taking off? Yeah, you need earnest money, you need a down payment, you need something if you're gonna do it. So you're not really gonna, you know, I guess you could get a no down payment loan for if you have really good credit, work, employment history. But in that situation, you probably want to put money up because it's gonna give you better rates anyway. Tesla sitting at 251, SPY at 556, Nvidia at 130s. Gold still pushing up some. Gonna watch gold. Opening bell is in about 2.5 minutes, chat. Meta looking strong. Yeah, there's the SPY. Forgot I was in the queue. We're gonna go ahead and sell this and just lock in our little day trading profit at the open. We're gonna be day trading a little bit larger once the open happens. So opening bell starts pretty soon. We're gonna be trading a lot larger once the opening bell happens. But again, we've been trading mostly flat, choppy behavior because we have Powell today. Meta's very high, so Meta's up to 534s. Buy or sell? I don't know. What should do there?
Still going? Yeah.
Well, the dude,
Yeah.
ready to drag there. Grab one, grab a butt.
Oh, it's such a huge.
It's just a drag, and that's a filter, it's a big filter. And grab a butt. There's just some dust in there.
That's
Alright, so we do have a pullback.
Oh, yeah, then I grab one.
How much do you expect to make a day when day trading? Said no more than stop.
Up and down.
No, not
Nah,
necessarily.
up and down.
It just depends on how big your account is. My account is going to be smaller or larger than other people's accounts, so it's all relative to your account size. In all honesty, it's how big your account is. A good trader can make 5 to 10% daily. I'm not sure if you're serious or not, Jimmy, but somebody sold you on get rich quick day trading, and you know, good luck to you, brother. It's all love here. I mean, I disagree. Jimmy says you can make 10% a day trading, which is just a ludicrous statement. All right, here's the opening bell, guys. Alright, so let's just say you make 10% a day. Alright. Let's say you got a $10,000 account. Alright. 1, 2, 3, 4, 5, 6. Oh, wait, my math is wrong. Alright, here's the opening bell, chat. Here's the opening bell. Good luck. 10% is never going to happen. The most elite traders make 30, 40% a year. You know, and the reason most of them are just full loaded. There's the opening bell. Let's trade. I'll go back into this in a second. But I'll tell you this. I promise you, if somebody was genuinely making 10% a day, if somebody was making over 100% a month, and they were on YouTube, they would post their broker statements like clockwork every single month. You know, sometimes you see people post one broker statement every single. Unlook.
Let's see. I want to see what GJ is doing here as well. All right. Oh, look at this. interesting price action.
Are you coming? No! My dad shares uncomfortable.
Really, Drac? Let's bite back against discomfort. Polydent Hold and Comfort helps keep us comfy with its pressure-absorbing layer. If your mouth could talk, it would ask for Polydent.
Stop would be a cell, let's say. The breathing is very high, is proven to be holding up, which is great. At the same time, you are facing a lot of resistance here, and the dollar has not proven yet that it's going to break down below the lows that put in the highs here. So let's say you have these lows, you have these highs, you pull back into this range. This is a key moment for gold now. The safer place will be simply wait for the closure above 2364, and then just look for continuation plays. That would be the safer play, and if it does break the lows here, I really believe that we could take it further down towards the 2247. Dollar is going to reach that zone very, very soon. And if the dollar holds here and it bounces from it, then in many cases what you're going to see is simply a reaction, a bullish flip, and gold is below that resistance, it starts rolling over, and you come back and fall back into the range. If the dollar keeps dropping and it just breaks through it, of course gold will smash through these highs here. And then the question is, okay, if that's the case, then what is the next best setup? Well, it depends where gold will be if that happens, okay? A closure above would give you a fantastic confirmation because it will be the hourly closure as well. Think about that confirmation in general at the same time. Let's see how price responds right now at this okay? At this low. What about news? Does it have an effect? It could have. It could definitely have. Yeah, it could definitely have. How do I use the LTA indicator? Which one? I mean, you can use the limitless LTA concept session breaks. Read the ebook, by the way, my friend. It's all in the ebook. It is all in the ebook. Let's see if you close here, or if you fall back into the range.
Oh.
Why do you use volume as a foundation? Because it shows you critical levels in the market throughout the day, throughout the week, throughout a swing, or throughout a fixed range, or whatever the case may be. And they're pretty precise. If you go back into the streams, we have tested it for yourself, then you will see a huge reactive from any of these levels. We have seen it over and over and over again. Over and over again. Yeah. This is a good option for today's news in gold. Well, there is not news, so it's not news, okay? It's just an event that will have some impact on the gold price potentially if they ask the right question and he gives the right answer or the wrong answer. It depends how you look at it, okay? But when it comes down to news, there is no event, there is no particular outcome we're looking at, okay? Not going to really be bullish or bearish for gold. It can be all over the place actually. Okay. Any closure below would not make it bullish whatsoever. If you start closing below the 2364, then I'm not the bullish anymore. If you close above it, I think that we might be holding up very well, and the dollar might be on its way down again. Right? Tapping into the highs, breaking down. That could flip the script. Okay? Yeah, 50-minute break would be a good start. But it's really about that 1 hour break, the 1 hour closure above here. Because think about this, right? You have still a long way to go. If that's the case here, then this might become less relevant as well. Like you're gonna dash it, but anything after that closure below doesn't make a difference for us to look for consolidation plays. So now I'm really open-minded if you start breaking above, closing above, then to see what we can do for. Are you only on Discord? We're only on Discord, man. Yeah, I'm not sure if there are any Telegram groups or whatsoever, but if that's the case, then get out of it as soon as you can. Because it's most likely a scam. Yeah. Yeah, look, how's your trading going? Oh, great. Well, have you ever copied me live Install this broker, make an account, and deposit your life savings. Okay, sir. Yeah, right. Yeah, it's pretty bad. It's pretty bad. Unfortunately, you get scammed all over the place. Yeah, it's something that you cannot just, you know, we do everything we can. Let's put it this way: we do everything we can to make sure it doesn't happen. Okay, but you know, you should also think for yourself. Like, does it make sense? Does it make sense that a random guy messaged me on Discord and asked me to put in, make an account on a brokerage platform and put in a bunch of money? I mean, I do get it, but I mean, wouldn't it be better if it would be publicly mentioned, publicly live on stream? You would have heard it literally from me live on this stream or whatever. Why would I message you personally? You just came into the community. You're brand new. Why would I message you personally? Whereas I'm new with Vantage, how do I make an account on it? For TradingView, oh. Yeah, for TradingView you need to, just go into your Vantage account and it says you create a new live account and boom, it's easy. And you set up a TradingView, it should be up, set in around, what, 5 minutes? And I think you get your account and that's it. It's not that difficult, but and then it doesn't matter if you place a trade on your MetaTrader or your Vantage account or TradingView, you will see the same amount. Okay? It's over there with each other. So it's kind of like a MetaTrader hybrid. It's not just Vantage or TradingView, it's also not just MetaTrader. But since I'm also a little bit confused between what will go right now, I can get why you're confused because we're in a range, and but overall I would say, and we have an event, we have a news event coming along, where Mr. Jerome will get interviewed, which can have an impact gold as well.
Uber and Walmart. My current portfolio includes, so it's diversified, but yeah, that portfolio is maybe thousands a year. Tesla dipping down a little bit here. How much in each? I mean, varying amounts. I'm not really going to go into debt about how much, or go into depth, I mean, about how much I'm up, or how much I'm down in each one, or how many I'm holding, or anything like that. It's unnecessary. I'm not telling anybody to buy anything as well. I have no idea what you should do, no idea what you should hold. All of these positions are positions I'm okay with losing in. And I just believe in diversification. I think you diversify into blue chips long term. I'm green on most of these, and I'm up thousands on, on the year. I am green, and in terms of how many of these I'm red versus green on, I am red in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I am red at 10 out of these, and this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 30, 40. I'm in 40 positions. I'm green in 30 of them roughly. So I'm about 75% accuracy with these positions. And these are a mix of swing trades and investments. Both swing trades and investments. Best one lately has been Intel. Remember, I bought Intel at the low 3s, or at the low 30s. It's up to 35s. We were patient. We waited. We bought it after earnings. You know, so if you look at Intel, my favorite strategy is very simple. It's I look for major weakness. I look for a beat up company that's down big. Like Intel has been, it was at 50 at the beginning of this year. It's now at 30, so it's down, 40%. And I look for extended weakness. It's Nvidia should be strong, and so I buy weakness in what I consider healthy companies, and I just kind of sit on them, see if they bounce back, and kind of a swing trade idea. That's kind of what I do. Yeah, so I buy food this month. Really need advice if I should invest in my nutrition. I'm not the guy to ask. I eat like a 12-year-old. You can ask my wife. Like, I'm not the guy to ask about that. I also train jujitsu pretty regularly though, and so I'm okay, but I'm probably not the guy to ask. Oh yeah, all good, yeah. All right, guys, we got 10 minutes. 10 minutes. Tesla at 255s. Intel is starting to break down though. Nvidia's testing highs again. Yeah, she just did good for me. I have fun doing it. I haven't traded for weeks now though. I'm ready to get home.
In a straight line. Align the rearview mirror with the parking space line. Turn the steering wheel full to the left. Drive forward. When the corner of the parking space can be seen in the right rearview mirror, turn the steering wheel full to the right.
Yeah, so Powell speaks in 7 minutes. 7 minutes. Let me switch my headphones out so I'm not rambling. Bears? What do you guys think? Powell is bullish or bearish here today? Got over 1,000 people here now. Let me know if you think he's bearish or bullish. Who knows?
No tips.
Do this poll here.
Nolan, I don't think we've ever met.
In this poll, what we're gonna do. Everyone. So far, this poll got 1.3 thousand votes. 51% think it helps the market. 32% think it hurts the market. 16%.
Which way you going?
Let's see the results. I'll do another poll here.
But I had the right of way, man.
What? I don't need to let every damn Korean on their rundown bikes through.
Thanks to this rundown bike, I can pay my rent.
Babe, let's go. We're wasting our time.
What do you mean? Who's gonna pay for my damages?
Get your stuff off the road, or we will run over it.
Quickly.
Alright, so are you bullish or bearish on today's Jerome Powell congressional testing?
We don't have time for this loser right now.
Bull, bear, neutral. Let's see results.
Do you remember our plan?
Babe, of course I do. 5 minutes and my husband will go.
I'm up 138%. Bearish, bullish. Oh, we got 6 minutes. ready.
little wavy baseline, and it's got a bit of a bump across the bottom of the two, the baseline of the two.
Waiting.
This is what it looks like in comparison to the normal one. So the normal point, very flat, straight line through here. The wavy baseline has that bump, and that's the one you look for. So up to $5,500. And in normal condition like this, I suppose, circulator condition, quite warm condition, it's been about $200 and $600. I've been lucky to find 3 of these coins.
Alright, so we are here. We are waiting here, guys. Let's put this video up.
You need to check the coins for. And yes, I've got this free
Make sure we got all the screens here. I'm about to switch out
We're here in Honolulu, Hawaii.
this.
At my grandparents' grave.
I'll just put the spy and we'll just put one chart up there.
All of you out there who love someone, this is for you.
That's nice of you.
Maybe I'll put this up in a new window.
Why is it a red, violet, and blue? If you don't drive a Kenworth, fuck you. Why is it a red, violet, and blue? If you don't drive a Kenworth,
It's too small. We're gonna have to keep the old window up. Go. Here we go. Spy up here. Watch the market. Gold up at the bottom, maybe here. Spy, you know how that works. Does that work? This should work pretty good. Yeah, I'm gonna turn the music off. Switch my headphones out.
My friend thought you were really beautiful. He just wanted to get your phone number.
No, for sure.
You ain't down? I was just trying to give you a layup. Excuse me. My friend thought you were really beautiful. He just wanted to get your phone number.
No, for sure.
You ain't down? I was just.
So I have to stop sharing my screen for just a second. We'll get this up. Go. You guys want some bright sun? This is bright sun. Here, less stuff going on. Spy right here. Go. Better. Go. Better view here. Alright guys, 50 seconds. We got about 2 minutes. this to start. Yep, I'm looking at the actual Senate page just to make sure, and yep, they haven't started either, so we're just kind of sitting tight waiting here, chat. We're just sitting tight waiting. We got it fully live. Sound should be on. I don't hear anything on my end though, so. Yeah, so we're just waiting. How's a little bit late. Market hasn't really moved a little bit. It's at 550s. Yep, we're waiting. Looking at this now. Yeah, I mean, it's on, you can check their own website. It's not. Yeah, I'm gonna check the background. Yeah, nothing's live on any of their ends. Yeah, so. Again, we're sitting here waiting for it to start. It should start right now, but they're not live yet. I've checked multiple different sources. They're not live. Trust me, I'm on these every time. We'll tell you guys when. You'll see when they start. Oh, not started yet. Wait, bear with me, chat. I gotta do this real quick. Just a second. Everything down. There we go. Yep, we're waiting for it to start. It's not live. We have it live already. A lot of people are acting like it's live. See it. Nothing has been said yet. But yeah, the report already, like, one part of the report came out on the 5th of this month. So it's already kind of out. But he's going to get interviewed by Congress. Right? So that's what you want to pay attention to. So, yeah. Yeah. All these. Can y'all hear that? Yeah, I guess so. Here.
Raising interest rates does nothing to address the biggest causes of rising prices right now: corporate greed. Keeping rates too high for too long threatens workers' paychecks while keeping other costs high, particularly housing costs. Housing prices and rents continue to go up. Since the Fed began raising rates, the amount of income families need to qualify for a mortgage has nearly doubled. Homeownership has long been a bedrock of our middle class, but today fewer and fewer middle class families can afford to buy a home. Higher interest rates are making our country's housing supply shortage worse, not better. We need more housing construction of all types. Higher rates lead to the opposite, and particularly make it harder for multifamily construction to work financially. Higher interest rates make borrowing more expensive for working families, whether it's for a mortgage or a car or anything else. Most people don't have the luxury of paying for everything in cash. And for the millions of Americans feeding their budgets stretched by higher prices, taking on credit cards Credit card interest rates are reaching all-time highs. Last month, Director Chopra testified in front of this committee and explicitly stated that credit card issuers are charging higher rates far beyond what they cover their costs. Corporate greed rearing its head again. Banks are making record profits at the expense of cash-strapped Americans. Every month, the Fed keeps rates high, Mr. Chair. It costs Americans money by making it more expensive to buy a house and to borrow money. Higher borrowing costs stifle future economic growth, leading to fewer homes being built, leading to businesses making fewer investments in the economy, and eventually, if the Fed doesn't stop, leading to workers losing their jobs. As they set economic policy, I urge the Fed to waive the offs and remember that jobs and futures are at stake. It's why I work with my colleagues to hold corporations accountable and will continue to do that. For instance, we fought to cap insulin prices for senior citizens. We'll continue to fight to extend this price cap on life-saving drugs for all Americans. And why my colleagues and I on this committee are working, it's why we're working to lower housing costs for more Americans. The Fed also continues its work to keep the banking system stable and ensure consumers' money is safe. Last year, the Fed and other banks issued a proposal to update capital requirements, strong capital standards, and you've heard in this committee overwhelming support for strong capital standards. They're critical for the economy. It's our way of making sure that if Wall Street bets go poorly, which they often do, investors, executives, and shareholders should pay for it, not taxpayers. The biggest banks have spent obscene amounts of money attacking this Fed proposal. But you, the Fed, don't work for big banks. You work for the American people. Your concern should be developing capital rules that protect Americans' money, not protect bank CEOs' stock portfolios. The Fed needs to look past these shameless lobbying efforts and finalize a rule in the best interest of taxpayers. Another dangerous piece of Wall Street business model that makes our bank compensation. I mean, you know, you read the reports, the outrage of the public about executive compensation continuing to go up and up and up and up. You have a role, a significant role, a legal role to deal with that. Thank you. Senator Tillis is recognized.
Thank you, Mr. Chairman. Thank you for being here. I want to be real quick on Basel III Endgame, and I want to be mindful of time. Just simply, can I get a commitment from you on releasing the results of the QIS?
Yeah, we plan to release the results of the QIS.
What's
not
that?
just, well, first we have to get agreement with the other banking agencies, but as soon as possible.
Can you imagine any agencies having concern with, any other banking agencies having concern with releasing it? Or is it just a matter of
Not at all.
Okay.
No, it's just a matter of the bigger picture of getting agreement on the revisions to Basel III and also how to proceed.
That's great, and I really appreciate the feedback that I've received from you. I should have started by thanking you again for your continued accessibility and discussions outside of the committee. They're very productive, and I appreciate that. Your leadership at the Fed. I grew up in the 70s. Got my Social Security number in 1973 when I was 12 years old. That's when I made my first payment. So I've been following the economy even as a youngster. And that was a really lousy time to enter in the workforce. Tell me, and I'm hearing discussions among some of our members now that would almost be reminiscent of discussions with prior Fed members saying, look, we got to lower interest rates and we've got unemployment out of control. So it sounds like we're taking some suggestions from some of my colleagues or plays from a playbook that didn't prove to be very effective back in the 70s. What can we learn? I'm not going to ask you about where you go from here, but if we look back and do a post-mortem on some of the decisions that were made when we had consistently high inflation, we had consistently high unemployment, what lessons can we learn there, or what mistakes should we not necessarily repeat? And I know that this is a fingerprint of a challenge. It's not exactly like the stressors that we had back in the 70s, but what can we learn from the decisions, what I think were arguably the wrong decisions made back then when we were dealing with high unemployment and high inflation? What do we learn?
I think the number one thing we learned was that it's up to the central bank to take it on and stick with it until it's done. And that doesn't sound controversial now, but it actually was back then. So people didn't really get in there and get it done, and inflation kept coming back. I also think there are significant differences this time to the questions a minute ago. This is a combination of a supply side that we have very significant supply shocks along with big demand shocks from the reopening of the economy and from all the other things that happened. So I think we have to, each one of these things is different in its own way. We try to learn the lessons of history though.
Agree or disagree? Any disconnect between inflation and inflation expectations from the 2% target should be addressed now and not at a later time?
Absolutely.
I like that answer. I want to go to something different. I'm trying to go into a lightning round now and finish on time. We've seen the 2024 stress test results for the U.S. banking system. It looks like to me, by every objective measure, we've got a banking system that's on strong financial footing. Do you agree?
Yes.
One last thing is the Fed considers making broad and material changes to the Basel III proposal. Back on that one. Can I urge you not to overlook the second order issues, important FBOs in certain regionals to ensure that banks are not unduly influenced? If the current proposal, for example, the outsized operational risk costs were high, are we going to take care of that in any sort of re-proposal?
Let me just say we're very conscious of the across the spectrum of banks, domestic banks, medium-sized banks. Everyone's going to get heard carefully as part of this process. That's our obligation.
I think in response to Senator Round's question, you did indicate that probably because of the nature of the likely changes from what Mr. Barr expected to what may ultimately come, we are going to open it up to comment again.
That's the strong view of the Federal Reserve. We're working on that question with the
Senator Tellis, Senator Warner of Virginia is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you again. Coming this late in the questioning, I'm going to at least hit a couple of the items that my colleagues otherwise already hit, just to make sure it's noted that I raised them as well. First of all, I agree with the chairman. You know, I probably hear more on housing and housing affordability than any other issue, and I agree with the chairman. I know we've discussed this around a rate cut, and I understand most of your answer, but I still want to add my 2 cents here. We've got to find a way to start bringing mortgage rates down, let people can unlock that housing market. And again, we've discussed the rate cut issue, and you've got to navigate that. But I hope it's sooner than later. I will not recap what I've done in the last couple hearings with you, but I do think the discount window proposal that I've got, that I know you're working on, you know, regulations that do meet in some cases. I think the discount window is an underused tool. It's one of the initial original tools for the Fed. A lot of my colleagues have talked about quantitative easing, Basel III Endgame. I do hope when we get the revisions that we'll see the quantitative analysis that, again, Senator Tellis already raised and other colleagues have raised. I also hope that one of the questions I raised in my March letter to you was, you know, making sure any new regulatory structure, how it intersects with existing regulatory structure in terms of market risk, credit risk, and I, again, hope that we will have that as the revisions come out. I think one of the things that this debate around Basel III raised was that it is, my understanding at least, looked at, you may be all looking at revisions to liquidity standards as well, and wanted to see what you could say about that and whether that part of those standards are under review, what your thinking is.
Yeah, I think that actually connects to some questions as well, where I think there seems to be a need to update assumptions about liquidity, and that's a separate proposal that we're also working on, and you know, very important. I think we saw how fast that run was. It was just exponentially faster than prior runs. That's the new world, and you know, that's some estimate of what that world is baked into things like the liquidity coverage ratio, for example.
Right, and wasn't that the case when, you know, if you had 25 cents on every depository dollar, leave in 6 hours, no matter what the capital standards are.
Yeah.
And one of the things I asked, there was a lot of talk after SVB that we need to think about internet-driven runs. A lot of us raised concerns. Candidly, I'm not sure I've heard any good proposals. So whether it comes from you guys or from folks listening, how we think about this new internet-driven world, and frankly, I think some of the irresponsible behavior by some of the folks that were major depositors in SVB, who in many ways shouted fire in the crowded theater, and we've not seen any action there. So I would welcome additional ideas as well. And that kind of brings me to my last questions around supervisory reform. I know the GAO criticized the Fed's supervisory procedures in the role they played in the 2023 failures. It is a whole brand new world. Are we going to look at, will your changes to supervisory standards be comprehensive? Will it be one-off? How do you think about that in light of the GAO report, and also in light of just the SVB and a few of the other failures we saw last year?
Vice Chair Barr is Vice Chair for Supervision, is leading a process of looking at the way we supervise banks and thinking about how we can be faster where it's appropriate, more forceful where it's appropriate. And I think, you know, they've taken a pretty deep dive and tried to learn these lessons and then implement them in a way that is appropriate. So that's a big project going on at the Fed right now, which really Vice Chair for Supervision leads.
I think I remember lots of conversations with the chairman, with you, with the FDIC, in that Thursday through Sunday. And I think the solution you guys came up with, the administration came up with by Sunday night was a good one, but they were a pretty scary 3 or 4 days. It didn't seem like the process, I don't know completely how you get fully ahead of that, but I firmly believe that there should have been a clearer early warning system. and trying to make sure that, that we wouldn't be in that kind of crisis situation going forward. And again, I would strongly encourage any additional thoughts on this technology risk and how we get that right. Thank you, Mr. Chairman.
Thanks, Senator. Senator Kennedy of Louisiana is recognized.
Thank you, Mr. Chairman. Mr. Chairman, our economy is slowing, is it not?
Yes, although still growing at a solid pace.
Our unemployment rate is rising, is it not?
Yes, it is, although the labor market is still strong.
Our labor market is slowing, is it not?
Yes, but I'd say unemployment is still, is still low by historical standards. But yes, it is. We've seen cooling. Yes.
And I was looking at the recent jobs numbers. I know you glanced at them too. About 3/4 of the net new jobs that were created in June were in government, healthcare, and social assistance. What does that tell you?
So that's a concentration. You'd rather see broader job creation than that. Those three areas have, in some reports, they've been, as it was this time, they've been the predominant creators of jobs. That tells you that job creation is becoming less broad in the economy and narrowing.
It tells you the government's creating those jobs, doesn't it?
Well, it's government. It's also in-person services. It's also some of it's government.
Manufacturing's been flat.
Yes, manufacturing's not creating a lot of new jobs these days.
Information technology shed jobs over the past 2 years, hasn't it?
I don't know.
Leisure and hospitality jobs have slowed almost to triple.
So that's a place where there was a desperate worker shortage, and they've done quite a bit of hiring, but they're catching up now.
I mean, three-quarters of the jobs that are being created in our economy can be related directly or indirectly to our spending deficits, can't they?
In this report, in this single report, I don't know that healthcare is really government spending. That's something people.
Where do you think these hospitals get their money?
They may get it, but I mean, people are not. The spending on healthcare is not necessarily directly related to deficits. Is my point.
I would disagree with you. I mean, here's my point. We talk a lot about expectations in terms of inflation. How if we expect there to be inflation, we'll get inflation. It seems to me that consumer expectations play a bigger role in the economy than we see today. Most of our economy in America is consumer driven, is it not?
Yes.
Unlike, say, China, which is manufacturing driven.
Very much so.
And I listened to you cite the statistics about the economy, but most Americans don't feel good about the economy, do they?
No, and we don't tell people how to feel about the economy.
I mean, isn't it a fact that most people, if you ask them to define Bidenomics, they would say that's easy. We get to pay more to live worse.
I wouldn't touch
You don't want to answer
a
that.
sentence with that word in it.
Yeah. I mean, we can pretty this up all we. I guess my point is, and I know you're going to do this anyway, but I'd be really careful with this economy. I mean, people just don't feel better off today. And one can marshal a persuasive argument that, well, you should, compared to Europe or compared to China, compared to Canada. But they, feelings are feelings. People don't feel good about this economy. And it's primarily because of inflation. Let me use my final 30 seconds to ask you. I listened to my good friend, the chairman, give his opening statement. Do you think inflation was caused by corporate greed?
comment on something the chairman was speaking about.
I'll go ahead.
Well, so I would just say, we see at the Fed, we see inflation as when there's an imbalance between supply and demand, and we use our tools to work on the demand side of that and bring it back into line with supply.
I got 2 seconds. So when are you going to lower interest rates?
I'm today not going to be sending any signals about the timing of any future actions.
Thank you, Mr. Chairman.
Senator Smith of Minnesota is recognized.
Thank you, Mr. Chair. Welcome, Chair Powell. It's good to see you again. I want to follow up on kind of the line of questioning that Senator Tester was on a bit ago. He was talking about how the U.S. economy has been outperforming other advanced economies around the world in terms of growth rates, in terms of unemployment, in terms of inflation, getting inflation under control. I think we obviously can all agree that we're not, at least from my perspective, we're not done yet. And we don't want to rest on our laurels, but I'm wondering if you could share what you think that we have learned from this experience. What have we done right? And why is it that we are doing better than some of the other advanced economies in the world?
I think that it's down to the fundamental strengths of our economy. So, as you may know, European economic officials are very, very focused on this question. They really, it comes up in all of our discussions. Europe has seen productivity increases of about 1% a year for 40 years. We've seen 2%. If you take a number and compound it at 1%, then compound it at 2%, the difference is just enormous after 40 years in terms of incomes and living standards. And their question is, why is that? Why is that? And the standard answer that Americans tend to give, and that I would give, is it's down to more flexible labor markets. In the pandemic, they stayed in their existing jobs. In the United States, we had people changing jobs at record levels, and that's the kind of thing that adds to productivity and it contributes to rising living standards, going back to school, getting skills and things like that. Another one is our financial sector. We don't just have banks. We have a highly developed ecosystem of financing sources that will fund early stage investments. Banks are really not set up to do that. They're prudentially regulated, and so those are some of the things. And I think we just have these natural strengths as an innovative, more flexible economy. We can grow faster.
Mm-hmm. I appreciate that. I think sometimes there's a tendency to sort of trash our economy and to sort of say, oh, we suck. And actually, I think that there's great resilience in our economy. I would argue that it has also to do a lot with the incredible resilience of our workers and their creativity and their talent and the training and the education that they have. And I think I would also argue, though I wouldn't expect you to make this case, that the way in which our federal government responded to the pandemic in order to make sure that people weren't evicted, that they still had money to pay their bills even when they weren't able to work, meant that overall our economy survived and was ready to kind of be off to the races when we emerged from the pandemic. But Chair Powell, I'd like to ask you a question, something that you and I have talked about, I continue to be thinking a lot about, which is the commercial real estate risk that we have in this country. I think particularly for office space, we know that has been under strain the last several years. The sector has remained largely stable, but you're hearing about some additional default risk. And one thing that I'm noting is that there's some expectation or concern that may fall disproportionately on smaller banks. I think that commercial and regional banks hold an estimated 2/3 of all the commercial real estate loans in the country. And so unlike larger banks, these smaller institutions might find it a little harder to deal with this. So could you discuss this with us? Could you tell us a little bit about how you see this risk and particularly whether this poses some additional risk that we might be seeing more concentration in the banking sector as these smaller banks are maybe under more pressure?
Yes, so this, to your point, this is a risk that has been with us and will be with us for some time, probably for years. And banks need to be, honestly assessing what their risk is. They need to be sure that they have the capital and liquidity and the systems in place to manage this risk. The stress test that we applied to the largest institutions stressed commercial real estate pretty hard. And again, the conclusion is that the some smaller banks that tend to have that local concentration in commercial real estate. And, you know, we're in touch with those banks, the supervisors and regulators are in touch with those banks, and making sure that they can manage them. And it's going to be an issue for many banks, but it's one that we're trying to work through, one that we're very much aware of, and again, it'll be with us for some time.
Thank you. I think so much about the importance of these small regional community banks in small towns, big towns in Minnesota, and how important it is that, in my book, that they can stay independent and better serve their communities in that way. So I worry about this risk. Thank you, Mr. Chair.
Thank you, Senator Butler of California is recognized.
Thank you, Mr. Chairman. Chairman, good to see you. And I am going to make you do the whole last 5 minutes, since I'm the last one, for today. You'll recall the first time that we spoke, I tried to engage you around 3 specific areas. One was how the monetary policy impacts the quality of life for young Americans in the future, and the work that you are doing there, the space of climate risk, and what I see as potentially a future challenge down the road, and that is the state of commercial real estate. You and I have had that conversation before, and no surprises today. I'm going to stick to those 3 topics. Somewhat related to questions that you've been asked before relative to the housing market, housing affordability, and interest rates. I want to narrow the scope just a little bit to ask about those issues and challenges impact, again, the quality of life for America's next generation. Given the severe shortage of affordable and available homes to buy, coupled with high interest rates, young Americans are continually unable to afford homes and are pushed into a rental market, driving rental costs up. So there is sort of trickle-down impact here. Recent Washington Post analysis showed that Gen Z is spending 31% more on housing than their millennial counterparts were 10 years ago after adjusting for inflation. How do you view, that was a long lead-in to just ask the question, how do you envision or view the interest rates of today and the monetary balance and policy balancing that the Fed is doing on contributing to the future generation predicament if we are to extrapolate the conditions of today?
So our job, of course, is the whole economy and inflation for the whole economy. And the absolute best thing we can do for younger people is to restore price stability so that as we benefited from, I graduated from college in 1975, near the end of the big inflation period. So during most of my adult life, inflation has just been not a factor. And that means, stable interest rates, relatively low interest rates. We want to get back to that. And that is what the Fed's job is that we're not supposed to look at the housing market as separate from the overall economy. In the meantime, there's no question that higher interest rates are making it harder to buy homes in the short term. But in the longer term, this is the best thing particularly for younger people who are not yet in housing.
Let me sort of in line with that community, constituency, population, and definitely aligned with the concerns of my state that's actually facing some severe climate impacts, just as we speak with wildfires and our colleagues and fellow Americans in Texas and the impact of the hurricane. I wanted to pull in your sort of thoughts about the Fed pilot on the climate scenario exercise. In May, the Fed conducted a pilot climate scenario exercise and asked the 6 largest U.S. banks to examine their balance sheets and how it would be affected if a large hurricane reported facing data gaps on property characteristics, their counterparties and insurance coverage. How does the Federal Reserve intend to invest in expanding modeling resources for banks that are implementing climate-related financial disclosures?
So we haven't made any decisions on what to do with that information or whether to repeat that exercise. To your point, it was really a learning exercise. How are banks thinking about this, and how are they modeling it, and how does it work really? It's a very, very challenging thing to model, and so that was really the nature of this exercise. In terms of disclosures, we don't really have that's not really our job. That's really the SEC. So, but you know, we don't have a big job on climate, but what it really is to make sure that the institutions we regulate are aware of and understand the risks that they run, including risks from climate.
And that they're prepared, and learning how to, as would be the point of a pilot, learning how to mitigate those risks over time. So what criteria will you use to evaluate whether or not you would run the exercise again and or share more broadly the results of that exercise?
I think we did publish, well, most of the results of that exercise. So I don't know what to say about that. We're looking at it and we're asking ourselves, what did we learn? What do we need to learn next time? So, you know, I'm not exactly sure what factors we'll be looking at, but we'll be doing a careful assessment of what more we need to do.
Thanks. Thank you, Mr. Chairman.
Senator Haggerty is recognized.
Thank you, Mr. Chairman. Chairman Powell, welcome. Chairman, last week in Portugal, you said that you wanted to be, quote, more confident that inflation is moving sustainably down before you begin to cut rates. You also said in your testimony that you need greater confidence and more good data before lowering rates. Can you give us any color as to what it is you're looking for in the data and how long it might take us to get there?
We need just to see more good inflation data. That's all. We, you know, we had 7 months of good inflation data at the end of last year. Then we had a quarter, really a month or so, where inflation went up, and now we had one really good inflation reading and one pretty good one. We just need to see more so that confidence rises. I'm not going to tell.
Are we weeks away, months away?
Yeah, I mean, I'm going to try to avoid sending any really specific signals about time today because it's going to depend on the data. It also matters what's going on in the labor market, though. You know, we've also said that if the labor market weakens unexpectedly, that could be a case for loosening policy as well. Really, we're weighing both those factors.
Here's one of my concerns, and I'm sure you probably share it, but we're coming off of a 40-year high in inflation. We've seen the rate of inflation coming down, but we haven't gotten to the 2% target, and my concern, for lack of a better term, is whether or not this might be transitory in terms of the data that we're seeing right now.
That's exactly why we're approaching this question carefully.
I thought that might be your answer. Thank you, Mr. Chairman. Can we shift now to the issuance of Treasury debt? You know, the Fed is the largest holder of Treasury debt. In February, you and I talked about the pressures that our fiscal deficit is exerting on interest rates, which by extension makes your job more difficult. I'd like to talk this time about how Treasury issuance is impacting our economy and our monetary policy. First, just a basic question. If Treasury issuance were to shift drastically, either to the long end or the short end of the curve, would that affect interest rates? Or maybe more simply, do changes in supply across maturities impact interest rates in the yield curve?
I mean, I think in theory they can.
I agree. As you know, the Treasury Borrowing Advisory Committee recommends that T-bills comprise between 15 and 20% of total U.S. debt. Right now, the Treasury is issuing T-bills significantly above that recommended range. Some people, including myself, believe that this is being done to artificially stimulate markets in the run-up to the election. And it's shocking how little attention this is getting. Any manipulation of debt management of this nature stimulates inflationary pressures and increases taxpayer burden because it's higher cost to issue these bills. So given that Treasury is issuing an excess of short-term debt, which pulls down longer-term rates, isn't it working at cross purposes with your monetary policy goals of taming inflation?
So we take Treasury's debt management decisions. We don't comment on them. We just do our job.
No, I'm not asking for a comment on their decision, but just as a simple mathematical truth, if they're pulling down demand on the long end of the curve, does that?
I wouldn't say that has important inflation implications. No.
You know, it just feels to me the same way that the Biden administration creates the Strategic Petroleum Reserve, that undermines our ability to respond to energy shocks. When the Treasury manages its debt in this manner, it constrains our ability to respond to future economic shocks. And that opens our nation up to very real risk, whether it be amplifying the effects of the Fed's balance sheet reduction, flooding the supply of one of the most important short-term debt instruments. The risks seem to me to be mounting for Treasury market disruption. I'd like to know what your thoughts are, Mr. Chairman, about how the Fed will navigate this, and whether you've had discussions with the Treasury about this growing dangerous dynamic.
No, we don't have a seat at the table on Treasury debt management. Treasury makes those decisions. They don't have a seat at our table on monetary policy.
just think the risk is very obvious here, though, where we're headed with this type of work.
Honestly, it's completely out of bounds for me to comment on Treasury debt management in any way.
I think you've been dealt a very difficult hand here, Mr. Chair. The Biden administration's policies aimed at gin up the economy ahead of the election. These efforts directly undermine your policy goals at the Fed. That includes excessive issuance of short-term debt. Think about it, Freddie Mac's backstop of second mortgages, unlawful student debt loan cancellations, the draining of the petroleum reserve to suppress fuel prices, and President Biden's own jawboning of the FOMC to lower rates. As you know, the Federal Reserve was structured to shield monetary policy from political influence. That independence has given the Fed unique credibility in executing its mission. If the FOMC were influenced in any way by political calculation rather than economic data, it would severely damage the Fed's credibility as an independent institution, it would increase uncertainty in our markets, and it would jeopardize the dollar status as the global reserve currency. Thank you, Mr. Chair.
Senator Warren, Massachusetts, is recognized.
Thank you, Mr. Chairman. When the CEOs of giant banks can boost their bonuses by getting banks to take on more risk, they run the risk that they will end up running their banks into the ground. It happened in 2008 and it happened again in 2023. Back in 2010, though, Congress passed the Dodd-Frank Act. Section 953 told financial regulators solve this problem. 2 months ago, regulators put forward a proposal, but the Fed refused to join. Now, in 2018, you told this committee, Mr. Chairman, that you, quote, expect that banks will have in place compensation plans that do not provide incentives for excessive risk-taking. In other words, you trusted the banks to write their own rules. So let's see if they actually have. One thing the proposal would do is require big banks to delay bonuses for a broad group of critical employees who are able to gamble with the bank's finances, like the head of a trading desk, for example. Chair Powell, in the 6.5 years since you said trust the banks to regulate themselves, how many of the 10 biggest banks have put policies in place to delay annual bonuses for this broader group of critical employees whose risk-taking could endanger the bank?
I don't know specifically. My guess is all of them. Since the
So
financial crisis.
you're the regulator who said trust banks to self-regulate so we can avoid another financial meltdown or another bailout. And you don't know if they did or didn't do that?
Well, you make it's a very, very specific
It's a
question
very
you're
specific
asking.
thing, because it's something a regulator should do. You think the answer is 10 out of 10? The answer is 0 out of 10.
Yeah, I doubt that.
Well, go back and look, because we've looked at their statements on this. Another thing the proposed rule would do is require the banks to consider flat out banning bonuses and bonus pay for executives who took risks that threatened the stability of the bank. So let me ask you this one, Chair Powell, in the 6.5 years since you said trust banks to regulate themselves, how many of the 10 biggest banks now have policies that would require them to flat out deny bonuses to executives that have engaged in inappropriate risk-taking?
I don't know the answer to that. By the way, I never said trust the banks to regulate themselves.
I'm sorry, do you want me to go back and quote you again exactly?
Trust the banks to regulate themselves?
When you say, I expect that the banks will have in place compensation plans that do not provide incentives for excessive risk-taking.
Right, pursuant to the guidance that we issued in 2010, which is quite
And you
detailed.
have not issued a guidance since you made these comments, since you became chair. And how many banks have actually put in place the regulations that you said, I expect the banks will have in place? The answer is out of 10,
It was covered
0.
by 2010 guidance.
No, you said in 2018 that they would put these
I
in
said they would
place.
have in
And
place.
no, that is not what you said. So look, Chair Powell, the last guidance on this subject, as you say, was in 2010, which is before you were at the Fed. The Fed has now refused to join the other financial regulators in finalizing a rule implementing Section 956 as Congress directed. So my question has been, how many of the 10 biggest banks have done this? And the answer is 0. Dodd-Frank was passed 14 years ago. There are still no rules to stop banks from rewarding executives' risky behavior. When you were asked about these Section 956 rules or lack of rules in March of this year, you said, quote, that you wanted to understand the problem we're solving before proposing a rule. Chair Powell, the law does not say Jerome Powell in his infinite wisdom should decide if we have a problem with executive compensation. The law passed 14 years ago says executive pay is a problem that threatens the stability of our economy, so write the rules to rein them in. Finally, the other financial regulators have proposed such a rule, but the Fed has not joined. Chair Powell, I understand why the 10 biggest banks in the country like your approach. You let them do whatever they want, but you don't work for the giant banks, you work for the American people. I urge you to do your job. Thank you, Mr. Chairman.
Senator Vance from Ohio.
Thank you, Mr. Chairman. Chief of my office. Last week we discussed some of these issues. I would ask something I imagine most of my colleagues are not asking, which is the relationship between immigration, particularly extremely high illegal immigration levels under the Biden administration, and the persistence of the inflation problem. And I recognize this is not your policy focus, but you are the Federal Reserve Chairman, so I just want to get your views on this. And in particular, I would read you a quote from Vicky Bowman, who's one of your governors. And this says, and I quote, "There's a risk that increased immigration and continued labor market tightness could lead to persistently high core services inflation. Given the current low inventory of affordable housing, the inflow of new immigrants in some geographic areas could result in upward pressure on rents as additional housing supply may take time to materialize. With labor markets remaining tight, wage growth has been elevated at around or above 4%, still higher than the pace consistent with our 2% inflation goal, given trend productivity growth." The Bank of England, I believe, produced a recent report on this issue in the United Kingdom, obviously different economy in a different country, but what do you see as the relationship, in particular given that housing is such a big driver of the inflation that we've seen in the last few years? Senator Haggerty said the highest in 40 years. What role do you see illegal immigration playing in driving up housing costs, which of course is the main driver of inflation for American citizens?
Let me quickly start by echoing your first comment, which is we don't comment on immigration policy, but we can comment on inflation. So I would say this: many people came into the country over the last couple of years. Many of them through asylum requests and went to work. Labor supply increased a great deal. It's not. There's no clear answer, but my sense is that in the long run, immigration is kind of neutral on inflation. In the short run, it may actually have helped because the labor market got looser because there were more people. But you're talking about housing specifically. There will be, I'm sure, there are places in the country where new people coming into the country, I'm sure you can find places and exist where that will have contributed to an already tight housing market. But overall, in terms of aggregate inflation, I wouldn't say it's a driver one way or the other.
So I want to follow up on that thread, but just on that topic of particular areas that have been affected. Chairman Brown, I'd like to ask unanimous consent to submit a letter for the record from the city of Springfield in our state, the southwestern part of our state, which I think highlights a very real example of this particular concern, straight from the horse's mouth itself. Now this letter, I want to quote from it: "Springfield has seen a surge in population through immigration that has significantly impacted our ability as a community to produce enough housing opportunities for all. Springfield's Haitian population has increased 15 to 20,000 over the last 4 years in a community of under 60,000 previous residents, putting a significant strain on our resources and ability to provide ample housing for all of our residents." And end quote there. And thank you. In my conversations with folks in Springfield, it's not just housing. They're trying to build 5,000 new housing units, which is a very Herculean task in a town of about 55,000 people. But it's also hospital services, it's school services, there are a whole host of ways in which this immigration problem, I think, is having very real human consequences. Moving this immigration and labor supply question. So one of the euphemistic ways in which economists, I think, sometimes talk about labor supply and immigration is they'll say something to the effect of, well, an increase in labor supply has put downward pressure on labor prices. And what they're effectively saying is that increased immigration has put downward pressure on the wages of American workers. I wonder, when you hear sort of your colleagues and other economists outside of the Fed talk about the influx of immigration and the fact that it, I think, admittedly has put downward pressure on wages. Okay, so there obviously that has put some downward pressure on inflation, but it also puts downward pressure on the wages that people earn to pay for their families. Why do we see that as a good thing? Or maybe that's wrong. Maybe the premise is fundamentally incorrect. But why do so many economists treat an influx of new labor as a good thing? If labor is constrained, labor supply is constrained, doesn't that lead to rising wages for American workers?
I'm certainly not trying to put a value judgment on it. I will say that this is all happening over the last couple of years in a context of an extremely tight labor market. Now a little bit less tight, significantly less tight, but you've got a worker shortage. You've got businesses who have jobs that are open. You have, more than one job open for an unemployed person. So you've got a very tight labor market, and it's addressing that. Wage increases are still very high, but they're coming down to a more sustainable level.
Fair. Mr. Chair, I know about overtime. Can I just one more question on this? Thank you. I understand your point, Chair Powell. And again, I'm not ascribing value judgments to you, but if we say we have a really tight labor market, and we say that there are more than one job openings per worker, there are two ways you can plausibly solve that. Probably more than that, but two obvious ways you can plausibly solve that. One is through a new influx of workers via the immigration system. Another way is by raising wages and bringing some of the workers that are on the sidelines. I think specifically of the 7 million prime age men that have dropped out of the labor force. Like, why isn't that more the focus of policymakers? Rather than, you see a labor shortage, rather than bringing in a large number of new immigrants, why not try to boost wages in a way that brings some of those workers off the sidelines? That seems to be a much better focus from my perspective.
Certainly, that's a very constructive focus. I would agree. It's not. I don't think it has to be one or the other.
Thank you, Mr. Chairman.
Senator Howland from Maryland is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you. And let me first applaud you and your team at the Fed for, at least so far, being on track to bring down inflation without, so far, triggering a surge, big uptick in unemployment. But you know very well that that's a risk if the Fed does not act with full awareness of that danger. When you were here in March, you said that you were, quote, well aware, unquote, of the risk to unemployment of waiting too long to cut rates, and, quote, very conscious of avoiding it, unquote. Since then, we have seen a slowing in the economy and a rise in unemployment. I'm just reading something today, an analysis with Diane Swank, KPMG's chief economist, who summed it up by saying, quote, the ice is thinning, red flags are emerging for the U.S. economy, unquote. The engine of the economy, the labor market, is cooling faster than previously known. The unemployment rate is above 4% for the first time since 2021. It is taking workers longer to find jobs. Economic activity in the service sector, which is responsible for 2/3 of economic growth, slowed in June. So my question, Mr. Chairman, is how do you take all of these factors into account? Do you share my concern that as of today there is a real risk of a increase in unemployment larger than is currently on your radar screen?
Yeah, I mean, absolutely. I do, even more so than in March when we were here, see that. So we've seen, and I think the latest data show that labor market conditions have now cooled considerably from where they were 2 years ago. I wouldn't have said that until the last couple of readings. And I would say also that for a long time, the risks were more that we would fail to hit our inflation target. I think the risks as to the two statutory targets we have, price stability, maximum employment, I think those are coming much more in balance. My colleagues and I are looking at that, and we fully understand that we have to manage this process of administering the federal funds rate and deciding what to do with it in a way that manages both of those risks. And the two mandates are equal under the law, and so yes, we do get that.
Well, I appreciate that, and I appreciate the fact that you've seen that sort of that calculation change since you were last here, because I think the data indicates that we are at risk now of not acting soon enough to curb the increase in unemployment, and if we allow that to go too long, we may see a real uptick there. And so I'm pleased that that is very, very much on your radar screen, and hope that that will be a really deciding factor as you and your other Fed colleagues determine what to do with respect to interest rates. And as has been said in the housing sector, we are seeing the continuing drag